Good afternoon, everyone. Today's the third day of August 2011. It's Wednesday, so let's go ahead and take a look at this market here on StockTwits TV. The S&P 500 finished with a little bit of a gain here today, up 68 cents, and kind of started out a little bit slow, and then we had that weakness. So initially, it didn't seem like we were going to get that flush, but we came down exactly to daily S2 in the S&P 500, and when we look at the 1 minute time frame, we got a sharp bounce from there, and this afternoon we had obviously a nicer bounce as well. Let's talk about the bigger picture first before we get into those details. But we take a look at the daily chart for basically the year. Yesterday we closed below this. What was this back here? March 15th or so close, and we made a new closing low for the year. I believe the close back there was 126.18. We closed with at our first loss for the year yesterday, so that was the first negative close for the S&P 500 for the year. And again, when we're looking at the market, we always want to ask ourselves two questions before we get involved. Where does the market come from? Where does it have the potential to go? In other words, what we've seen in the S&P 500 and what we've been anticipating here was that we've seen such a strong downward move that this might in fact be a little bit of a fake out, that we get that breakdown through the key level that everyone's been talking about, through the lows for the year, crush it a little bit below there, and then get a sharp bounce. And that's exactly what we had. We were referencing the way that occurred 2 weeks ago when the financials first dropped through their year low right in here, and then subsequently we had a very strong bounce over the next 4 or 5 days. Now in the S&P 500, I think only a fool would say that's it, we've seen the worst, the lows are in, and that sort of thing, because we've done some real damage to this market. If we take a look at the trend line, we've broken that a couple days ago, actually on Monday for the first time, and that led to some further weakness. And we've got this bigger picture here that everyone's now talking about and making fun of, and a lot of people don't know whether it's just so obvious that it can't work, or that everyone recognizes it's so obvious that maybe it will work, and that's this head and shoulders pattern. There were some good tweets about that one today, but the market's below the 200-day moving average. We've seen that before in this environment, and it didn't lead to the death of the market, but it did lead to further correction through time. And then after several months of healing back in 2010, then the market was able to reestablish that uptrend. That still might be the case for the S&P 500. If you look at fundamentals and macroeconomics and that sort of thing, it's kind of well, I will just say tough to believe if you look at that. So again, that's why I focused my attention on price action. What I'd noted today too was this level that we had come down and touched was about the 38.2% retracement of the lows from 2010 to the highs of 2011. So if we take a look at this being the starting point, the low point in 2010, up to the highs that we saw just back in May, well, the market came down to a 38.2% correction, and that's where intraday, basically around that area, we found some buyers, and that's also pretty close to this prior resistance from late last year. So this level in about that 123.5-ish area is going to be going forward an important level. Now what we want to look at is we had big volume, so we've had increasing volume on the way down here, and that's what you want to see, is expanding volume in the direction of the trend. And then what we would likely see is a little bit of a further bounce, but then the volume will diminish on the way up. If the volume diminishes on the way up, well, we still have a declining 10, 20, and 50-day moving average. I don't think that this is going to necessarily be the halting point for this rally. That is the 126.5 level. I think if we take a look, for instance, at this 65-minute time frame, and I don't know why that was already drawn in there, but basically here's about where we are, 126.5-ish. I think from 126.5 up towards about 128, that this prior band of support will be the level where we would expect to see some resistance if this market continues to rally. And we've had such a strong sell-off that you would expect that since this rubber band got so far stretched in one direction, that would snap back a little bit further. And I don't think 128 is unreasonable, but we are still below that declining 5-day moving average. So we are still guilty till I didn't do alphatrends.com. Did I say that? Anyway, let's get back on track here. The 5-day moving average is still declining, and we had a strong bounce, and it was quite tradable in there today if you're a day trader. But it's not something that you want to or that you can necessarily trust. In my mind, I actually have a very small position, some Russell 2000 exposure, long, but I've got a good price in there. But basically, it's more of a hope trade that we do see kind of that reversion to the mean and a little bit further snapback. But the market's damaged, and of course we've got that head and shoulders pattern that everyone's talking about. Now, when everyone starts talking about a head and shoulders pattern, it generally is not going to be something that holds true. I was trying to think back, and I think it was over in here. I'd have to look at a better daily chart, but I think this was the last time we had a very widely broadcast head and shoulders pattern in the S&P 500. And I could go back and look probably that July of '09, and I remember doing blog posts about, hey, a lot of times from the failed moves come the fast moves. So from the failed breakdown, sometimes we'll get a snapback rally that's stronger than people expect. Maybe we get up towards that cluster of moving averages up near the 130 level. 130 has been key here over the last several months, resistance and then a support. So we're looking like we're in bounce mode, and maybe we bounce a little bit further, but you simply can't trust it with that declining 5-day moving average. So when you have an oversold condition and you're looking at it saying, well, I don't want to sell short in here because we've come down too far too fast, but you're sitting there, you're looking for opportunity, and you're taking what appear to be low risk trades, at least from an intraday perspective, and looking at the 1-minute chart and saying, so for instance, this afternoon we were looking at the at this market because it was basically coiling like this. We had this higher low, and we bought right in here, and the target was actually the 2-day volume weighted average price, which it came up to and had trouble with. That was, in my mind, maybe because I had the biggest size on it, but that was the trade of the day, at least for me and in our chat room today. That was the best trade because it worked quickly as well, and we were right on it at the proper time. But as far as continuing to hold, it to me just doesn't make a whole lot of sense. We're still in a very uncertain environment. That's what we have here. The question becomes, is this a larger stage 3 distribution pattern that's going to lead to the next bear market? Well, we have a trend line break, and now we have to see, does the market make a series of lower highs and lower lows? If we rally up towards that 128 to 130 and the volume diminishes and we start to head back down, then I think there's a stronger likelihood that we are going to see, that we should be looking for the next potential levels of support down near 118 and 121. Those are, possibly coming, but right now they're a little bit too far off. That we need to see this market again. You don't want to sell short after a big drop, just like you don't want to be the long buyer who buys right here after the big advance. So where has it come from? It's dropped basically 10 points on an intraday basis in the last 2 weeks, 8% or so. So it's expended a lot of downward energy. Where did it have the potential to go before it was likely to encounter support or some bounce? And this is the level. We've overshot it, obviously. It doesn't mean that we aren't going to continue back lower, but right now I think you have to be nimble. The NASDAQ this was a great example. We've been talking about this since this day right here. Actually, since this day on the 25th, which is from a failed move comes a fast move. And what we saw in the NASDAQ was a breakout to a 10-year high, and that move, very similar to what we were calling talking about back in what was that, March, I guess, in the Russell 2000, where we had that breakout, which that failed move led to a fast move lower. So let me stop jumping around so much and get back to the NASDAQ here so we can take a closer look at that. On the daily chart, the bigger picture, let's just back that up a little bit. We came down. We came down to where? To that 55 and a half level that this market broke out from. That was similar to in the 130 level in the SPY. So here's that similar level. Obviously, the NASDAQ has held up better. We've still got it closing above that 200-day moving average. The market's flirting with that 200-day moving average, and this prior little resistance did come down and hold as support intraday today. When we take a look at the weekly chart, we've got a much more bullish look to this chart as well, that if we come down towards the 54.5 to 55 level, and we basically got down to 55 today, that's where we would expect some support to be found. But the bigger picture here, I mean, just look at this year and just draw two lines that look like this, basically from 54 up to 59. This has been our range. Basically, we've had about a 10% range, and just if you just kind of go like this, we've had how many of these 10% moves? 1, 2, 3, 4, 5. Here's this, the sixth or so 10% move, and the market hasn't really done much of anything at all. Maybe up a couple percent. I don't know off the top of my head, but I think it was about maybe 2%. So the 57 level was an important level that we're looking at, as far as it's a cluster, an area where we have some key moving averages, like the green 50-day moving average right in here. We also see, if we back it up, we've got on just a little bit further, we've got that blue line is the 100-day moving average, and the green line is the 150-day moving average. So basically between 57 and 57.10 or so, we've got these three bigger moving averages, and they're crossing back and forth. And what do crossing moving averages represent? They represent indecision. Well, we don't need crossing moving averages we don't need to wait for a moving average to cross to tell us that there's indecision in this market. We've known it for a while just by looking at the choppy price action. Now, if we look at the 30-minute time frame, we are still below a declining 5-day moving average. And what we were talking about just on Monday was that, sometimes you're going to miss out on a gap higher, but there'll still be enough of that meat on the bone that we can take advantage of these trends. The object isn't to try to pick this bottom or that bottom or whatever you perceive to be the bottom, because a lot of people have tried that, and maybe you got it right today, and maybe that will hold for a tradable move, a continued tradable move. But in this NASDAQ, we're also still below that declining 5-day moving average. So I'd rather go mainly into cash at the end of the day, hope for maybe some kind of pullback, and then see if we can get an upside rally to stick for a little bit, or at least intraday, that where it sets up in a stress-free way that we can take advantage of it, and we have trend line breaks, and we have these triangles forming, and then we get some volume as the market moves. Those are the types of things that we want to look for. In the Russell 2000, this market has been the bigger issue here. Is this $77 level? We broke below it today. We're right on it. You could call this a head and shoulders too, if you want to call that a shoulder, a head, and then a shoulder here. When we back that up to a weekly time frame and look at this trend line, we basically came down and touched that trend line. And if we take a look in here, this is why that $75 level became an area of support. Enough people stopped selling, enough people started bidding. Were they bidding because, hey, it's on the trend line? Were they bidding because this prior resistance? Or was it just a lack of supply that came in and buyers got a little bit more confident? Either way, this is clearly a key level here in this 75 area on the Russell 2000. And to be looking at it and saying, hey, I'm going to short below the neckline of that head and shoulders pattern, you're generally going to get you're going to experience losses basically, because again, where has it come from? Just in the last 2 weeks, down from 84 and a half down in intraday to just, let's just call it 75. So we had a 9-point range, a little bit. What it was at about 11% or so. 11% move from the highs a week and a half ago to the intraday low today. And usually, after such a big decline, it's not the best time to sell short. If we continue to bounce in here, well, we've got this level where we're at, basically this 77 and a half, and maybe up towards $79 a share or so. I think that's where we would expect to see maybe a little bit further resistance, and then if this 5-day moving average can begin to flatten out again and then hold as support, then we'll try the long side and see how long the market tells us that we should be in it. People say, well, what's the price target? What should we be looking for? Well, we can look at it and say, maybe it would bounce up towards 81. That's a potential area of prior support which became resistance. So if we get this rally, it pulls back, the 5-day moving average flattens out, and we get a bicep, we'd say maybe it gets up to 81. But if instead, let's just call this the 81 level, and this is where we are. So let's say we do something like this, and then we come up to, we break out a little bit, and then we start breaking down and we see this pattern of lower highs and lower lows. Well, this is where we want to get out. We don't want to get out when, just because of our price target and where we think the market should go. The markets don't do what we expect them to do. A lot of times, what we look for, and that's what money management is all about, risk management. The semiconductors have been the leading group, and today they actually led the rally. They began to rally a little bit first. And we were observing that. We saw that it hit this daily S2. But the semiconductors have been a mess for a while. We were talking about the 32 level. They broke that 32 level 2 weeks ago, and from that failed breakdown, and after a big decline from that breakdown, we saw this nice rally in here of about 8% or so. And now this time we broke below it. So 32 and a half. Basically, I would call it about 32.25 up to about 32 and a half. This is where I think that we would expect to see this band of prior support to hold as resistance if we get up there. So, maybe these semiconductors can bounce another dollar or so, but they're really a disaster here. They're in very tough shape, very similar to the financials, and the financials had that same type of move, as we know. But the financials are in a downtrend. They've got a declining 50-day moving average, and these are the types of time-tested principles that continue to hold up, which is, we trade in the direction of the primary trend. The intraday or intermediate term time frame, when we've got a declining 5-day moving average, it's generally guilty till proven innocent. On a 1-minute basis, you want to trade in the direction of the volume weighted average price. That's the way I see things, and that's the way that I've stayed in this business as long as I have. It's not always about making big home runs and hitting the low. That feels good. It feels nice to be able to maybe buy it at 124 or say, hey, I'm going to put my bid in right here, right on S2 and get filled. That's guessing, though. That's not risk management. And you can say, well, it is risk management because I have a small piece and I added to it, and that's just style. It comes down to what is your particular style in the market, and that's where the analysis, as they say, the technical analysis is an art form, but there's a science to it as well. There's general principles. It's not necessarily a science that we can say head and shoulders patterns on a weekly time frame 7 out of 10 times will result in this or that. You have to define it further. What's the direction of the 10-day moving average, the 50, the 200, the 100? There's a lot of subjective analysis that goes into it, and who's going to be right at the end of the day? I think the people that have the most experience are generally going to know to do the right thing, or to look at the market properly with the combination of the technical analysis, some psychology, just general gauging the psychology. And I saw about 15 tweets in a row about the head and shoulders pattern, and it's hey, it's a legitimate, valid pattern. There's people should be recognizing it, but it's also funny to see after such a big drop. So anyway, it comes down to finding your time frame, finding your style, and if other people don't, if people disagree with your analysis, that's what we have a market for. Don't waste your time with people on Twitter who want to argue points about, no, it's not that, it's this or whatever. That's why we have a market, and that's the right way to do it. So, anyways, I hope everyone made it through this storm here, this most recent storm in the market over the last, couple months. It's been a volatile year, obviously, and we'll talk again on Friday. Thanks for tuning in.